Manager at Trivest Wealth, Wellington Altus. Martin, thanks very much indeed for joining us. What jumped out for you in the news today?
Just the overall level of depth and the continuation in what's happening in the broader markets, continuing to push to new highs. A little bit of take back, but overall, there's a lot of loose financial conditions. And so, that's driving a lot of speculative assets, and that's, we're seeing a little bit of a pullback. But generally speaking, the trend is going to continue, and there's just a lot of appetite for what's happening out there.
You think interest rates have come down enough to keep the stock markets rocking and rolling?
Well, it's really interesting you mentioned that, because if you take a look at the U.S. dollar and the 10-year, it's diverged from commodities, it's diverged from equities, and so you have something called the equity risk premium. The equity risk premium is the level of a premium you're going to collect by going into the stock market. So basically, it takes a 10-year yield and subtracts it from the S&P dividend yield, and so right now it's negative. So what that means is that investors are paying to take on risk. And so either the bond market's wrong or the stock market's wrong, and so one or the other. And we're a really interesting situation. So bond market is being a lot more bearish than what equities are telling you.
And you do think this is a crowded and expensive market. What do you mean, Martin?
Yeah, so you have 1/5 of the S&P 500 gains over the last years come from one stock, NVIDIA. That's more than all of the Magnificent Seven combined. To put that into perspective, the world's largest stock, Apple, contributed only 3% of the S&P's return. And then when you take a look at multiples in itself, the forward PE multiple for the S&P of the top 10 stocks is 30 times, much higher than the 25 times we saw during the 90s dot-com boom. Now, having said that, these companies are much better financially than they were in the late 90s, early 2000s. But the difference being is that that's reflected in multiples, in addition to that negative equity risk premium. So if you look at the bond market, it's going to pay you more than if you invested in the stock market, and that's really interesting.
Martin, I should note, just before we go on, we had a banner there that wrongly said this was the TSX's first close above 25,000. It actually did that Thursday of last week, for those who are data-minded. What do you think of the banks in Canada? Obviously, every portfolio pretty well has to own banks if you're going to resemble the index in any way. Is there much upside for our big lenders, our beloved banks?
I don't see. I mean, they've had a heck of a run. I really like the banks 6 to 12 months ago, and then we went to an overweight. Dividend yields are attractive. They're making money. The falling interest rates have certainly been beneficial in regards to supporting the underlying consumer and their stability. Looking forward, there may not be a huge amount of growth left there. And so owning these banks, getting the dividend, and maybe doing a covered call strategy to add some income may not be a bad strategy. Even when the laggers, like you just mentioned, Scotiabank coming back again, people are moving down market within the banks themselves. Royal Bank was doing really well. Now people may be taking profit there and going into Scotia. That to me looks a little bit to the end of the cycle on that. But you're getting a nice dividend. Again, if you could add some risk management by doing a covered call, that's not a bad way to play it.
Interesting stat here that you've seen, that the average retail investor in the States is up, only 4% this year?
Yeah, that's crazy. I read that. JP Morgan, 3.7%. And you're looking at the S&P double digits. I think it's 24, 25%. It's best year in 88 election years. It's just been fantastic. Best election year in 88 years. The point being is investors try and time the market and then let their emotions get the best of them. So at the beginning of last year, things did look frothy too. And we had a heck of a run in 2023. And so investors said, I'm going to take some money off the table. Maybe they took too much off the table and went to cash. And their cash and the rates on their cash was going lower and lower. So getting 3.74% is terrible. It just goes to show how market timing is wrong. Now, I do worry that those investors are saying, well, we missed out. and they start buying in what I just described at multiples that not seen since the 2000 tech bubble, and they're coming in at the wrong time, that would be catastrophic because you made 4% in a year, and then if markets do correct 10, 15, 20, whatever that number is, you're going to be in the hole for 2 years. And so that just goes to show that you don't want to time the market. You always want to be in the market. You want to diversify your portfolio and still have a position, even in some of the tech stocks that have done so well.
Martin, we better leave it there. Thank you very much indeed for joining us.